Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in the home studios for today's podcast with my good friend Ezra. Ezra, how's your day treating you so far? February 1st.
It's going well. I'm not looking forward to the repetition of tomorrow, but other than that, I'm doing great. How are you doing?
Doing great. We've got some good stuff to talk about today. We got a couple questions from the client base here at Shepherd Wealth Management. Some very consistent questions this time of year being tax season.
Nice.
So part of what we do here for our customers is sit down with them every single quarter, kind of going over their quarterly results, performance-wise, how they got that performance. And right now, as we're in Q1, we're preparing the documents that they need to actually, hand that over to a CPA to prepare and file our customers' taxes. We do all of that as part of our overall service at no additional cost for households that have $500,000 invested with us or more. We prepare and file their taxes through qualified CPAs. We can get those individuals on the line with us, at pretty much any day and time to make it convenient for customers that do have very specific tax-related questions to get those answered. And it kind of builds into their overall retirement plan that we run for them, of course. And we just want to make it convenient and simple for people to get these very important things done. And taxes is not a straightforward subject for sure. There's a lot of gray area, and hence the reason for and demand for CPAs. So we have some really good ones we work with here in the Cincinnati area, but we also have some in Pennsylvania as well. But we have another office headquartered there in Lancaster, Pennsylvania. But anyway, the questions that were asked about were relating to Social Security, like how is Social Security taxed while I'm in retirement? So I went to the Social Security website. That way we could, again, get answers directly from the horse's mouth, if you will. Of course, in this case, being the IRS. But according to the Social Security website regarding income taxes and your Social Security benefit, about 40% of people who get Social Security must pay federal income taxes on their benefits. This usually happens if you have what they call, quote, substantial income in addition to your benefits. They define substantial income very vaguely. It would include things such as wages, earnings from self-employment, interest, dividends, and other taxable income that must be reported on your tax return, things like rental income, et cetera. And you must pay taxes, of course. So kind of give you an example of this. If you file a federal tax return as an individual, so it's just you're filing your own tax return, and your total combined income that you receive is between $25,000 and $34,000. You may have to pay income taxes up to 50% of your benefit, right? If you're falling in that income range. If you're making more than $34,000 as an individual tax filer and you're receiving Social Security benefits, so more than $34,000, up to 85% of your benefit may be taxed. Now, for those that are joint tax filers, if you and your spouse, significant other have a combined income that is between $32,000 and $44,000, notice that the income numbers are a little bit higher here for a joint tax return. But between $32,000 and $44,000, you may have to pay income taxes up to 50% of your benefit. And if you make more than $44,000 as a joint tax return, up to 85% of your benefit may be taxed. And if you're married and file a separate tax return, it's very likely and very probable you will pay taxes on your Social Security benefit as well. So if there are more specific and direct questions, obviously, you can certainly reach out to me. We can talk about it. 513-630-2664. Everybody can also go online, make a phone call to your local Social Security office. They'd be glad to make an appointment with you. And answer a lot of those questions, give you some examples of what that might look like, and of course, certified public accountant would also be able to take care of all of those questions. So you got to think about it this way, though. It's total income, right? So if 40% of Americans are going to have to pay taxes on their Social Security benefit, that makes a lot of sense to me because at some point, even if you are retired at, let's say, 65 years old and your full retirement age, according to Social Security benefits, is like 66 and a half, and you go ahead and file your Social Security at 66 and a half, and you start receiving that Social Security benefit, even if you're not taking any money out of things like your IRA accounts and 401ks, eventually, at the age of 73, you'll be required, according to the federal government, to take out what's known as a required minimum distribution. And we talked about this a little bit during our last podcast that we did. You can check that out, shepherdwm.com. And there's links right at the top of the page that takes you to all the podcasts we've done on on YouTube, of course, Spotify as well. And at 73, the government's saying, hey, you got to save all this money in a tax sheltered account like a 401k or a traditional rollover IRA. And you've had all this money grow. You've never had to pay taxes on it. Now, all of a sudden, you're 73 and the government's going to say, hey, you have to start taking a small amount out every year. That amount changes every year based on the balance of the account at the end of every year. And the IRS has their own little table for a divisor to come up with a calculation for what you're supposed to be taking out of your account every year. So if you have to take out, let's call it $20,000, $25,000 from a IRA account because you're 73, that's income. So even if you weren't paying taxes or paying a much smaller percentage of your Social Security benefit in the form of taxes, now all of a sudden you have $25,000 in additional income that you're going to be adding on to your tax return, which means that you may be, in fact, paying more and more taxes on that Social Security benefit. So just keep that in mind. And it's definitely a very important topic for our customers, which is why I think it's very important to do a full-blown retirement analysis, not just to make sure that you're ready for retirement, that you're comfortable and confident about, actually hanging them up, if you will, like going to your boss and saying, hey, I'm done. I'm going to retire now. But you need to have that confidence. But you also need to make sure that information is accurate. So when we run these retirement analysis, the output is only as good as the data that you put into it. So we absolutely have to take into consideration things like where you live, what state you live in, whether or not you have a state income tax. If you have other sorts of income, such as, rental property, part-time work, etc., all this stuff gets built into a retirement analysis, how you spend money, how you save money, how you invest it. We run all of this stuff through what we call Monte Carlo simulation, where you're taking all these variables, including your tax situation, including when you're going to file for Social Security. And we run it through 1,000 different market simulations, both good, bad, and everything in between. It spits out a probability distribution saying, hey, Ezra, you are 83% probability of success being able to sustain the type of lifestyle that you'd like to have between the ages of 65 and, let's say, we planned out to 95. So all that is what I do as a certified financial planner. It's my most favorite thing to do for individuals. And this is one of the questions that came up recently when we ran a retirement analysis for a customer. Their analysis looked great, and this is one of the questions, and I thought that this would be something worth talking about in a podcast setting, given the fact that we are in full-blown tax season at this point. So wanted to get that out there. And then another thing that we've talked about, so this is part of the reason why we do this podcast show. And I know that the viewers that have been watching for a while and people that have been tuning into the program have gotten a lot out of it. And what we are really here to provide is not just what the news is projecting as a headline risk, if you will, because that is the news' job, by the way. And the news understands that human beings are hardwired with these emotions called fear and greed. This behavioral finance subject basically teaches everybody that is willing to listen that human beings feel losses twice as much as we feel good about making a gain. And if the news understands that, well, they're going to placate to that fear part because we feel that twice as much as we feel good about making a gain. That's how they're able to keep your attention. That's how they're able to sell more ads. That's their job. So definitely not knocking them for doing their job. They do it very well. But what the news does not do a good job of is providing you any historical context or very little historical context. And what I mean by that is, yes, there's always a headline risk, but there's always been some sort of historical precedent saying, hey, yeah, we've been through this 17 other times as a country and an economy, and here's what happened to the various sectors of the S&P 500 under these circumstances. Here's how human beings responded to that said, quote, headline risk. And once we understand what human beings have done in the past, now we can formulate some probabilities behind those decisions and gives us a better opportunity to position ourselves correctly to benefit from those historical precedents, kind of expecting them to happen again. Now, of course, past performance is not a guarantee of future results, and investing involves risk, including risk of loss. But the one thing that Warren Buffett famously said about human beings is they do not learn from history, which is why we want to spend quite a bit of our time looking at what history has to say over similar, headline risk events, so that we can give ourselves the best probability of achieving the results that we're looking for our customers. And one of the things that prevents individuals from achieving the results that they're looking for is they have a very difficult time controlling their temperament. And we talked a little bit about this in our last podcast. Temperament's really just how you can control your emotions under stressful circumstances, given all these headline risks, and given the fact that, like for our customers, they are either retired and enjoying their retirement, or they're maybe still working. And these individuals have families. They like to travel. They like to do charitable work. They like to generally have fun. And while they're working in their working years, do the very best they possibly can at their job, so they can feel good about themselves, but also to take care of their family and their finances and their future retirement goals. So that's what they are doing day in and day out. But we all have these phones on us 24/7, or at least most people do. And we get these little alerts, these little notifications all day long. So we got all these other things, these other priorities, these other thoughts that are coming through our mind. I don't know, thousands of thoughts every minute. All that adds up over time, and we're thinking about a vacation, maybe how we're going to pay for our kids' college, and I got this retirement in the future. How are we going to make sure that I can, cover my healthcare costs? Like, all these different stressors are going on. Plus, we get these little notifications on our phone saying, "Hey, the S&P 500 is down 2% today because Jerome Powell said that we're not going to be cutting rates in March," when the market was pricing in a potential rate cut in March. And all of a sudden, the market sells off. And you're kind of in this moment where you've got all these other stressors, all these other things that are grabbing your attention. Now you're seeing this headline risk and all the red next to your portfolio, or maybe the positions that you're watching on your watch list on your phone. That's going to cause some tension emotionally. And what I've found here, the best way to get control over your temperament is to understand what history had to say under very similar events. Like, the market's made up of human beings. And the one thing we know for sure about human beings is we haven't changed that much in over 2,000 years, which is why I think it's so important, and why I think Warren Buffett talks about the importance of understanding the historical precedents of whatever the headline risk is. And that's a big reason why we do this particular podcast. Now, in addition to that, part of my job is a little bit like being a therapist, right? Because of all these stressors that are coming to the attention of the individual investor via some sort of news outlet, while they're going about their very busy lives or enjoying their retirement years. They don't want to have that kind of stress. Well, unfortunately, there's always these surveys at this time of year, given the New Year's resolutions that people have, et cetera. So there's a poll, it's called the Harris poll, on behalf of the American Psychology Association, found that adults between the ages of 35 and 44 have experienced an increase of both chronic health conditions and mental health diagnoses since 2019, while 50% of adults between the ages of 18 and 34 report struggling with mental issue. And one of the biggest stressors for most adults, according to this poll, especially parents, is money and the economy. Now, as we continue through this survey, the survey found 67% of adults say that their problems aren't that, quote, bad enough to be addressed above, and believe other people have it much worse. But nevertheless, 47% of adults surveyed wish they had someone to help them manage their stress. So we got some conflicting data points for sure. Now, I don't know if these numbers are, like, when I first read this, I thought it was something I expected. Like, when you hear that kind of information, as I know this isn't necessarily what you get paid to do for a living, but did that surprise you at all? Was it too high, too low? Sound about right? Because to me, when I read that, I was like, yeah, that's about right. But I've been looking at these surveys for a decade now, so I've kind of had a good understanding coming into this year that it was likely, data that was going to be similar. But did those numbers surprise you at all? Just curious.
Yeah, I mean, maybe it does seem a little high. I mean, certainly not with like the contemporary stressors factored in, but I guess retirement is just such like a, okay. So now that you've asked me that question, I've had a little bit of time to like objectively think it over. Maybe it is kind of more in line with what I would think reality is, but there's just such a big boogeyman about retirement for so many Americans, I mean, it used to be, I feel like when I talk to people in our parents' generation, or even Gen X, the generation just like right above me and you, there's a lot more of a given, like there was just a more clear and easily understood pathway to retirement. Whereas for some reason now it's just a giant jabberwocky. So anytime I hear those numbers or statistics about it, it always comes across as like a little hot, you know? Um,
Yeah,
but
yeah.
when,
I mean,
you know, after thinking about it a little more, it does kind of seem more realistic, those numbers, you know?
yeah, the prior generations had a pension, right? They had Social Security, they had a pension, and then whatever they could save. But it was great because like the ideal, I get to ask this question all the time, like what's the ideal retirement scenario? Like bulletproof my retirement. Well, one thing is your lifestyle is relevant, right? People want to do different things. Some people, need to have more income than others to be able to sustain the lifestyle that they want to have. So lifestyle is relative to the individual. That's number one. Number two is most people that I see in retirement don't usually struggle with the money part. They struggle with being bored. So that's an interesting thing that I've learned just kind of personally here. But as it relates to these stressors, so this is also coming from the same American Psychology Association. So they're kind of giving some tips here, some helpful tips that would be beneficial to those that are having this stress, specifically around the topic of money. And I happen to agree with it. So I think the most important one is education. We always fear the things, that we truly don't understand. And that's not just with money. There's all kinds of different topics that we could say, yeah, if we would just understood their perspective better or had more information or education on the topic and the people involved, then we would make better decisions. So number one, if you are that busy and you are stressing out about the future of retirement, the unknown, all the uncertainty of, how am I going to pay for these things? What do taxes look like? How is Social Security fit in there? What's the optimal time to take it? What's an efficient way to transfer my wealth to the next of kin tax efficiently? Should I, be fortunate enough to leave some sort of legacy? If we can educate ourselves in that, and if you are the individual that is very busy or just would rather, quite frankly, go play golf as opposed to, doing the types of research that we do here, that's exactly what firms like mine are here to do. That's the service that we're providing. But being able to either educate yourself or work with a group or an individual that does have the right education and expertise of walking through, the retirement years with people from all different kinds of lifestyles and different states that they live in and all that. I think that's the number one thing that you can do. And the second most important thing that they talk about, which we talk about all the time as surprise, surprise, is emotional regulation.
Yeah.
Isn't it?
That was just me telling you that's my reflex when somebody talks about retirement. It's like, when it gets my emotions all worked up.
Exactly. Because we don't want to, as human beings, right? It's all about the human being. It always boils back down to the human being because we get this freedom of choice. So the more that we can understand things, I think the better decisions that we ultimately make, at least the more consistent, better decisions that we ultimately make. But being able to get control of your emotions. How do you do that? Well, for me, what I found to be the most successful is to educate myself, again, on historical precedents in the market. That's exactly what Warren Buffett and Charlie Munger have done at Berkshire Hathaway for over 60 years and outperforming the S&P 500. They were asked directly at their last shareholder meeting last year before Charlie Munger died, is that, hey, why aren't more individuals, corporations, groups of people kind of following your playbook? You guys have already spelled it out on how you do it. What's most important to you when you're making an investment decision, like how you kind of control your emotions. Like they literally laid out a playbook over multiple decades, and without hesitating at all, Warren famously said to the person that asked him that question, we got rich slow. Like the majority of the money that Berkshire and Warren Buffett, Charlie Munger made were past the age of 60. And in this world, people want
rich slow.
Exactly. Now, to be completely fair, Warren and Charlie made some really good decisions way before they were, 60 years old. And they obviously at that point in time, 70s and 80s, they were pretty wealthy individuals relative to most people in pretty much any country. But the majority of their wealth was built after the age of 60. Now, the other thing that they also admit to is they had the fortunate longevity, right? So being able to live a long time with this sort of knowledge, being willing to apply that knowledge over that long of a period of time consistently is really what compounded the growth and wealth that they were able to create. But the point being is they had time to educate themselves, and they were able to look at what history had to say, what other human beings were doing, what they did under similar circumstances in the past. That's how they made a lot of their investment decisions. Yes, they had to understand things like balance sheet and income statement, taxes, and all the things that go behind the scenes for evaluating a company and their future prospects of growth. All that stuff is important. I'm not just saying you need to get some education and figure out a way to control your emotions. I think those are the two most important things, because the third thing, understanding what you're actually looking at, how to evaluate a company and their prospects of future growth, that is the third thing. So number one, get the education. Number two, we have to regulate the emotions or control that temperament. And the last one, once you have those two under control, and you have the probabilities of saying, hey, it's more likely that the tech sector under these circumstances historically has done better than these other three sectors. Therefore, I'm going to allocate more of a weighting to those type of companies in that specific sector. Now I can go in and use those skills that I've developed as a certified financial planner, doing this stuff for over a decade, reading all these different books, not just in school, but through the eyes of a Warren Buffett and Charlie Munger. Now I can use all of their information to go about evaluating whatever securities in the tech sector, whatever sector I'm looking at. That's kind of the recipe. And it starts with the intangible things that we have a difficult time getting our arms around, like education on Social Security and how that plays into retirement, and, require minimum distributions, and then controlling my emotions. And then I can actually go about doing the research to figure out what positions and what weightings I want to own. So those are two, I think, excellent topical questions for this time of year regarding Social Security taxes, and then how do we kind of get a grip on our personal financial situation, whether it's doing a New Year's resolution to do your very first IRA contributions or your very first 401k contributions, or you got some sort of resolution to say, hey, you know what, I'm getting a little long in the tooth, retirement's getting closer and closer, I need to prepare myself better for that. I think these are great topics to address, and I'm very thankful for the questions that were asked by our customers.
Yeah, I mean, obviously I don't have the expertise that you do, but I can tell you from someone who's not very old but still wants to retire, that it's you're never too early to at least start thinking about it. I mean, I understand that things are very difficult for a lot of young people, especially in their early 20s and mid 30s. You're not always able to save, but that doesn't mean that you can't start coming up with a game plan, or even thinking about, like, the things that you said, Joshua, like, what do I want my retirement to look like? What do I want my lifestyle to be? Because it's never too late to start thinking about it. And even if you can't, actively contribute as much as you'd like to. So.
Yeah, I think these are great topics. And as I think about my future retirement, which I have a hard time. I know I'm in the business of helping people through their retirement as a certified financial planner. Very proud to be able to do that. I enjoy it quite a bit. But I don't actually plan to have Social Security at all for my future retirement. Now, that may actually be something that I do get to receive. I mean, I am paying into it. Mm-hmm. So for all of those that are getting Social Security, you're welcome.
Yeah, it's our money. Yeah, it won't be there when we show up.
Actually, I heard a statistic yesterday from Jeffrey Gunlock, who's a well-respected, very large investor. He was on CNBC yesterday. This is after Jerome Powell dropped the bomb on the market, which I'm going to get to. That's kind of the main subject here, if you will. But he was giving out some statistics on Medicare and Social Security, and the statistics were something to the effect of Social Security going to run out by like 2032. Medicare running out of resources by around 2030. Okay. But he also talked about, how they are coming up with these projections of running out of funds for these two programs. And they have to project as well. Just like when we're running a retirement analysis for a customer, we're using that Monte Carlo simulation. We're using all these different variables, using what history had to say, and coming up with some probabilities and some statistical projections based on that data, right? So they have their own models as well, but he was talking about how the models are assuming, no recession at all. they're assuming, very favorable interest rate environments, much lower than what they are right now. They're assuming all kinds of things that are kind of Goldilocks scenarios. So his whole point was it's very likely that some of those programs might run out of funds sometime here in the 2020s as
That's
opposed to the
ridiculous because it's
2030s.
2024. Like that's in like a few years. We could start calling that months. Like that's how close that is.
Well, yeah, and that's what caught my attention because his other point was that this election cycle that we're about to go through, and I guess are going through, this will not be the election that entitlements is kind of like the thing that gets somebody in office or out of office. But they do believe the 2028 presidential election will be all about, the deficit that we have in this country and all these other programs that are likely going to be very close to, if not already on the threshold of running out of resources. So I think it's going to be, like he mentioned, Jeffrey Gundlach on CNBC yesterday. I do agree with that. I do think I think it actually should be talked a lot more about right now. Unfortunately, Congress and politics, as we all know, has a very slow process that they go through. And obviously it's very emotional and some people, we don't know what the outcome is, right? That's the unfortunate part of it. And that's what I think caused a lot of emotions, both sad and angry and everything else in between. Whether you're an individual investor, whether you're a retiree, benefiting from these programs, or you're somebody that's looking forward to retirement, kind of expecting some of this to be there, and we don't really know what the outcome is. So I thought that was worth bringing to everybody's attention as well here today, as we're kind of talking about Social Security and taxes as well.
Yeah, thanks. I mean, we just got through a segment talking about emotions around retirement, and now I'm terrified. So I appreciate that.
Well, to shift gears a little bit then, because that's definitely not what we're here to do.
And never talk about it again.
I think it's coming. We'll be talking about it more and more, but until it's more of a headline topic that more and more people are centered on, I think we'll just continue to roll with what people are focusing on right now. And right now, as we're talking here today, on February 1st, the anticipation for big megatech earnings is what's coming up here. So we got Google, better known as Alphabet, as well as Microsoft, who gave their earnings just a couple of days ago. And their earnings were great. The stocks did terrible after earnings. Both of them beat the top line. They beat the revenue. They beat the earnings. They beat them by a wide margin. Google, unfortunately, or Alphabet does not break out. This was the revenue from, YouTube versus all their other business silos. But Microsoft did give their Azure numbers, their cloud business numbers, and they have reaccelerated that growth quarter over quarter and year over year. So, I mean, literally all the boxes got checked, right, from a earnings perspective for those two big companies. But the stocks did terrible after their earnings announcement. Specifically, Alphabet was down, I think, 4 or 5%. On the day after really posting a great quarter. So I'm not sure what caused the buying signals there. To me, I didn't see anything. It was a great opportunity to re-enter the position if you were not in it. And as it continues to find its footing, if it falls much farther, I'm certainly going to be considering adding more to that for our customers. But today, on February 1st, after the market closes at 4 o'clock Eastern Standard Time, we will get earnings from Apple, Amazon, and Meta. Also known as Facebook. And I'm expecting all three of these companies to kind of knock it out of the park. I think the biggest one that people have a question mark about is Apple. Not that there's a problem with Apple, but they've had slower growth all of last year. All quarters were slower growth. Stock did fine in 2023, but the question this year is, are they going to be reaccelerating growth? Are they finding other avenues such as their services? Where they're getting additional growth from. So it's going to be interesting to see how that plays out. And of course, Apple is the largest stock in the S&P 500. It's 7% of the whole entire S&P. It's the largest company on the planet. And therefore, today after the close, it's kind of like a mini Super Bowl for me. I'll be closely watching this and being ready to make any changes, rebalancing changes if we need to. Now, these are core holdings for our customers. Alphabet, Microsoft, Apple, Amazon, Meta. These aren't really things that we trade much at all. They're typically core holdings. It's just a question of the weighting that we want to have in any of these. So last year we were uber bullish in tech, specifically mega cap tech. I think personally before the rest of the world decided to join in, and that's just not my opinion. You can actually go back to shepherdwm.com and check out our newsletter from January of 23. We're talking about expectations for double-digit returns in the market. It was all based on historical data. We were accurate on that, and it's only because we paid attention to what history had to say, even though all the market pundits were calling for, recession or even worse in 2023, and that obviously did not happen. So very much so looking forward to today at 4 o'clock, 4:30, we'll get all these earnings reports, and we will respond accordingly. Outside of earnings, the historical data that I wanted to present to everybody before we talk about Jerome Powell's press conference yesterday, which was pretty typical. His prepared remarks were great, and Q&A started and all hell broke loose. So I want to get to that, but I did want to give the people some good news here. So we talked about some of the questions regarding Social Security, Americans having stress. We got these earnings expectations, which can cause some emotions, obviously some stress, depending on if you're heavily invested in it, you want it to do well, and therefore, making some money. If you are heavily invested in these positions and do poorly, obviously that doesn't make you feel very good. And if you're out of all these positions and you missed all of 2023, you got this FOMO going on, and you're not really sure if the markets are going to have a good year again this year. It's an election year, yada, yada, all these geopolitical risks. Well, here's some historical data. This is why historical data matters. Number one, because it did give us probabilities last year saying, hey, everybody else thinks that all the bad stuff is going to happen. What could possibly make us agree with that, or what could make us have a different opinion on that? And history gave us that different opinion. Well, here's what I would have to say to those that are dealing with some of these emotions relating to earnings, geopolitics, and all this other stuff. So over the past 74 years, when we've had the prior year have a performance in the S&P 500 greater than 15%, so prior year being last year, S&P was up 24%, which was greater than 15%. So over the last 74 years, that's happened 28 times. We've also followed that prior year with a positive January. That's happened 13 times. The full year median return was 16%. And the full year return was positive 92% of the time. The only exception was 2018 of all those 74 years. So the probabilities are in your favor that this is actually going to be a very good year. We've been calling for double-digit performing year, not just because of this data point, but if you also look at what history has to say under an election year, you got a Democratic incumbent president rerunning for office. The S&P has averaged about 12%. So between all these different historical measures, going back 100 years, going back over the last 74 years, looking at all these different things that have happened under very similar circumstances, the median returns have been positive. They've been double digits, and they've been positive more than 90% of the time. When you throw on top of the fact that we are in earnings season, and not sure if you knew this, but earnings have been fantastic. We're actually 108 companies reporting this week, but of the 186 companies that have reported so far, that's 37% of the S&P 500. 81% of those companies are beating estimates, and those that are beating by a median of 7%. So this is healthy stuff right here.
Yeah.
Between the historical data, between the earnings that are coming through exactly the way that we were hoping them to come through, and the fact that we are going to get interest rate cuts at some point in time here in 2024. Those are really good ingredients. Those are three great ingredients: history, earnings, as well as Fed cuts. Those are great ingredients for a very good S&P 500 kind of year. So we're very bullish on the market, but we do think that the majority of investors' returns in 2024 are going to come when we get our first interest rate cut. And that takes me right to yesterday. So yesterday at 2 o'clock, everybody was anticipating no interest rate changes, meaning that the Fed decided to not increase rates or decrease rates. The whole planet was expecting that they would do nothing at the meeting yesterday, and that's exactly what happened. The fireworks started to come when the Q&A happened. So the questions were pretty much all centered around, hey, you've acknowledged that we've done a good job of getting inflation back down. The Fed's favorite core PCE came in at 2.9% just a couple of weeks ago. They're shooting for a 2%, sustainable target for that number. And all the data is pointing to the fact that we are going to hit that number probably late this year, maybe sooner. We'll all find out. So the question is not if they're going to cut rates, but when. So the question was, hey, Fed Chair Powell, the market's pricing in about a 50% chance or so of an interest rate cut in March. Do you expect to follow through with an interest rate cut in March? Now, generally, as you know this, we've been doing this Fed conversation for, I feel like 2 years.
Yeah.
And every time Jerome Powell has gotten a direct question like that, like, hey, are you guys going to do this at the next meeting or the next future meeting or whatever? He's always danced around the question. Right? I mean, am I wrong about that? This guy has just been dancing around these direct questions for 2 years. Am I wrong about that?
You're not wrong. I mean, we call him never a straight NASA around here. Never a straight answer, Powell.
That's right. Well, he did give the straight answer yesterday, and this is what caused the explosion. So here's what he had to say, quote, based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that meaning a rate cut. But that is to be seen, end quote.
So he kind of hedged it there at the end with that's to be seen.
Yeah, I guess he gave himself that little window. But here's the thing, and this is a quote from Comerica Bank's chief economist, Bill Adams. He said, quote, the Fed was badly burned in late 2021 and 22 when they thought that high inflation would be transitory, then got caught by surprise when it was higher and more persistent than expected, meaning inflation was higher and more persistent than expected. They wanted to avoid making the same mistake twice, meaning that they're still dealing with their damn credibility, right? They were late to the game in increasing rates, and they look bad because of that. Like their job is price stability. That's one of their mandates and maximum employment. So they definitely dropped the ball on the price stability point. But they did what they had to do, increasing rates, the fastest pace we've ever seen since the 1980s, early 1980s. That did work. We were and are able to control inflation without destroying the job market, which is awesome. Yeah. But the Fed is being late to the game, most likely, in cutting rates because they again don't want to have egg on their face saying, oh, we took our foot off the brake too soon. Yeah. Right. But the problem is every day that you keep interest rates where they're at with the federal deficit that we have, you are making the issues of running out of things like Social Security, Medicare, all these programs, that risk is going up exponentially every single day. Now, I know that they know this, right? I know that I'm not the guy here in America that was like, oh, damn, here's a problem.
Look what I found in this box.
I know that.
Covering the secret info,
Yeah. And I know that they know that. But the problem is I don't understand why these human beings can't think for themselves. They collectively as a group have had this kind of mantra of we're all going to be unanimous in our decision making. So yesterday's vote was unanimous not to change rates. Like all these votes to increase rates, keep them the same. The whole time Jerome Powell's been as Fed chairman, and even before that, Janet Yellen and people before her have basically gone with a unanimous vote. It doesn't really freaking matter. Like the Fed chairman is the only person that has a voice. Like everybody else could say, raise rates. And Jerry could be like, no, and we're not going to raise rates.
And that's it.
That's it. So he wants this unanimous sort of decision-making process. I think that he's right. That is a healthy way to go about doing things. But the fact of the matter is the issue of keeping rates higher for longer, this dumbass mantra that they've been, this drum that they've been beating for 2 straight years, it did the job, but you don't need to be here anymore. You have inflation falling to that 2% target. It's very likely that you're going to see it before the end of this year, or definitely by the end of the year, most likely. And they're likely going to be late to the game in cutting interest rates. I can give you a lot of reasons why they should cut in March. I think it would be absolutely the right decision to make. He's giving himself some window, I guess, to potentially do that in March. So it doesn't look like a complete fool, but I guess at this point he would look foolish if he decided to cut rate. I mean, he would have to come out and say, I'd be extremely humble, like, hey, I know that we said this in January, like that quote that I just read off to everybody, but because of the data, because of all these other reasons, we have to humbly admit to ourselves that we've been able to achieve our mandate. We can see where the interest rates are going or where inflation is going. And therefore, we don't want to choke the economy and cause a recession that otherwise isn't necessary. The economy is healthy. Therefore, it makes some sense for us to take a healthy interest rate cut after increasing rates as much as we did. Like, he would have to come out hat in hand, a lot of humility. I think it would go over great, but that's likely not going to happen based on the comments that we got yesterday. And when the market, go ahead.
No, I'm just still aghast.
So here's the deal. Like, the market is a weighing mechanism. So people are trying to price in, all right, interest rate cut in March, or at least a probability of that, leading into yesterday. So let's call it 50% chance probability of a rate cut in March. Now I have to look at the securities that I want to have or potentially own in my asset allocation. Are they fairly valued, undervalued, or overvalued? But they're using some sort of discounted cash flow model to do that. And that is 100% based on where interest rates are going to go. And if interest rates are coming down, it makes the present value of those cash flows worth more, just strictly based on math. And when the market's pricing into securities a potential rate cut that they don't get, it's no hell in the wonder that we got a 2% sell-off in the NASDAQ yesterday, nearly a 2% sell-off in the S&P 500, about 2% sell-off in the Russell 2000. Now, a lot of that's recovering today, or at least stabilizing, hasn't fully recovered from yesterday's kind of bloodbath post Jerome Powell grenade that he dropped on everybody.
Yeah.
So I expect more of the same, a lot of volatility. I think we talked about this since the beginning of the year. I know I've talked about this with every customer during the last quarterly review, is I expect a lot of volatility in the latter part of Q1, like February and March, because the market is anticipating a rate cut that I don't believe that they're going to get, that Powell basically said you're very likely not going to get. And because I believe that he's a man of his word, more or less, it would take a hell of a disinflationary piece of data for them at this point to cut rates in March. So if the market's pricing it in, it wants it, it knows it's a healthy thing to do, and they don't actually get it, I expect volatility. Therefore, I would highly recommend, or at least consider, rebalancing your portfolio, just like we've done for our customers early this year and even late last year. Taking some gains. Most of our gains came from tech last year, and redeploying those into other areas historically that have done very well in an interest rate cutting cycle. But I'm not going to do all that at once. I believe our first rate cut is in May. I think that you'll actually, have a lot more reasons, and I think a lot of politicians will even give them more and more reasons to strongly consider cutting rates sooner than later post the March deadline, or not a deadline, but the March meeting. Well, I don't believe that they're actually going to have the stones to cut rates, even though I believe that they should. So there's going to be a lot of pressure on the Fed. A lot of data is going to come out between now and then. But I do believe that May 1st, you will see your first interest rate cut. Therefore, I want to be fully positioned in the stuff that I believe historically will do well this year because of what history had to say under similar rate cutting cycles. And I think the majority of people's double-digit returns coming from the S&P will not happen until we get that first rate cut. And if it's in May, I believe May 1st is the Fed meeting. So very beginning of May, that's kind of the back half of the year, roughly. So kind of expect most of your gain to come from the back half of the year post that rate cut. So that's what our expectations are at this point, based on what Jerome Powell had to say yesterday. So we'll see what unfolds. We do get a couple jobs reports and a couple inflation reports before the March meeting, but like I said, I think it would have to be very disinflationary kind of data, meaning that we all of a sudden have a huge spike in unemployment rate, and you just see the CPI, the headline inflation numbers just fall off the cliff, which they will, but I'm not so certain that we're going to see that before we get to March. So that's our 2 cents on all that for you guys that are wondering where we stand as it relates to the Fed and interest rates post announcement yesterday.
Great.
Now with that, I'm not sure if we got any other topics to get to today. I think we're up on our time. But definitely hit us up for any questions that you want us to address on our next podcast. We do these every 2 weeks. You can check us out at shepherdwm.com. All my contact information is there. You can drop us a question however you'd like, and we'll continue to address those as well as other current events going on in the marketplace and what history has to say about those events. So I hope you guys enjoyed this one. Hope you guys have a great rest of your February 1st, and we'll see you again in a couple weeks. Take care.